What if economic decline doesn't happen suddenly, but follows a pattern that repeats across history, almost step by step? Before you dismiss that as theory, consider this. Major powers like Spain, Britain, and even the Soviet Union didn't collapse overnight. They went through recognizable stages, often while appearing stable on the surface. If you want more clear, structured insights like this, take a second to like the video and subscribe. Because understanding patterns is what helps you make better financial decisions long before outcomes become obvious. Now let's clarify something important. The idea of a collapse pattern doesn't mean everything fails or disappears. It refers to a gradual shift in economic strength, influence, and internal structure over time. These shifts are often driven by debt, productivity changes, policy decisions, and global competition. And they tend to follow sequences, not identical, but similar enough to study. Here's where you should be cautious. It's easy to take a framework like 7 stages and assume it predicts the future with certainty. It doesn't. What it does is provide a lens to analyze trends more clearly. Because every economy is different. The United States today is not Spain in the 1600s or the Soviet Union in the 1980s, but patterns in debt cycles, institutional strength, and economic transitions can still offer useful signals. So instead of asking, "Is collapse coming?" a more useful question is, where are we in the cycle of economic strength and adjustment? Because once you start thinking in cycles, you stop reacting to headlines and start understanding structure. And structure is what shapes outcomes over time. The first stages in most historical economic cycles are actually periods of strength. Nations expand, productivity rises, and institutions become more powerful. Trade grows, innovation increases, and confidence builds both domestically and globally. This is the phase most people recognize as success. But here's the key detail that often gets overlooked. Success creates its own pressures. As economies grow, they tend to accumulate debt, not necessarily because of failure, but because borrowing becomes easier and more normalized. Governments invest more, businesses expand, and consumers spend with greater confidence. At the same time, global leadership brings responsibilities, military, political, and economic, that require ongoing resources. None of this is inherently negative, but it does create a shift from pure growth to managed growth. And that shift is where the next stage begins. As debt levels rise relative to income or output, the system becomes more sensitive to changes in interest rates, productivity, and external shocks. Growth may continue, but it becomes more dependent on policy support rather than organic expansion. Now, here's where many interpretations go wrong. Rising debt alone does not mean decline. What matters is whether that debt is supporting productive investment or simply maintaining current living standards. That distinction is critical because productive investment strengthens future capacity. Maintenance spending does not. So when analyzing where an economy stands, you don't just look at debt levels, you look at what that debt is actually doing. And that's where the pattern begins to reveal itself. Not in headlines, but in underlying structure. As the cycle progresses, one of the most important shifts begins quietly. Productivity growth starts to slow relative to expectations. This doesn't mean innovation stops. It means the rate at which the economy expands through real output becomes less dominant compared to financial expansion. In practical terms, more growth begins to come from asset prices, credit expansion, and financial activity rather than from producing goods and services. Now, this is where interpretations often become too simplistic. It's easy to say financialization is bad, but that's not accurate. Financial systems play a critical role in allocating capital efficiently. The problem arises when financial growth significantly outpaces real economic productivity, because when that gap widens, the system becomes more dependent on asset valuations staying elevated. At the same time, inequality often becomes more visible, not necessarily because wealth is being destroyed, but because it is being distributed differently. Certain sectors, finance, technology, asset-heavy industries, benefit more from this phase than others. Meanwhile, Areas tied to traditional production may not grow at the same pace. This creates a divergence in economic experience. On paper, the economy may still look strong. Markets may perform well. But beneath the surface, different groups and regions begin to experience that growth very differently. Now, here's the important nuance. This stage does not mean collapse is imminent. It means the structure of growth has changed. And once growth becomes more dependent on financial conditions than on underlying productivity, the system becomes more sensitive to changes in confidence. That sensitivity is what defines the later stages, not failure, but fragility. As sensitivity increases, the next phase is often characterized by greater reliance on policy intervention. Central banks play a larger role. Governments adjust fiscal policies more actively. Interest rates, liquidity conditions, and stimulus measures become more central to maintaining stability. Now, this is where many narratives become exaggerated. Policy intervention is not inherently negative. In fact, it is often necessary to stabilize complex economies. The question is not whether intervention exists, it's how dependent the system becomes on it. Because dependency changes behavior. When markets begin to expect consistent support, risk-taking patterns shift. Investors may become more comfortable relying on policy backstops, businesses may delay structural adjustments, governments may prioritize short-term stability over long-term restructuring. Again, none of this happens all at once. It builds gradually, and during this phase, economies can still function well. Growth can continue. Innovation can persist. But the underlying resilience of the system begins to depend more heavily on maintaining favorable conditions. This is where the idea of stage progression becomes useful, not as a prediction, but as a way to analyze increasing reliance on external support mechanisms. Now, regarding the claim that a country is in stage 5, you should approach that critically. Labels can oversimplify complex realities. What matters more is identifying the characteristics: rising debt sensitivity, policy reliance, slower productivity growth, and evaluating how they interact. Because economic systems don't follow rigid scripts, they evolve based on decisions, constraints, and global context. And that means outcomes are shaped not just by where a country is, but by how it responds to the pressures it faces. At this stage, one of the most important dynamics to understand is how confidence interacts with the system. Because in complex economies, confidence is not just psychological. It directly influences investment, spending, and capital flows. When confidence is strong, systems can sustain higher levels of debt, more aggressive policy, and elevated asset valuations. When confidence weakens, adjustments can happen more quickly. But here's where the conversation needs precision. A shift in confidence does not automatically mean collapse. It often means repricing, rebalancing, or structural adjustment. Markets adjust, policies adapt, capital reallocates. This is why historical comparisons need to be handled carefully. Spain's decline, Britain's transition, and the Soviet Union's collapse each involved very different political, economic, and global conditions. While patterns exist, the outcomes were not identical, and neither are modern conditions. Now apply this thinking practically. Instead of trying to predict whether a system will fail, focus on how sensitive it is to changes in confidence. Ask questions like, how dependent is growth on continued asset appreciation? How flexible are policy responses? How diversified is the economic base? These are measurable, actionable considerations. Because from an investor's perspective, the goal is not to predict dramatic outcomes. It's to understand how systems behave under stress and how assets respond to those conditions. And that understanding allows you to position more intelligently without relying on extreme narratives. So where does this leave you? If there's one takeaway, it's this. Economic systems evolve through stages, but they do not follow fixed destinies. Patterns exist, but outcomes depend on decisions. The idea of a 7-stage collapse can be useful as a framework for thinking, but only if you use it carefully, not as a prediction, but as a tool to analyze structure, risk, and resilience. Because the real world is more flexible than any model. Countries adapt, policies change, innovation creates new possibilities, and global dynamics continuously reshape the environment. Now, from a personal finance and investing perspective, the implication is straightforward. You don't need to predict the exact stage or outcome to make better decisions. You need to understand how different environments affect different types of assets. In periods of strong productivity, growth-oriented investments may perform well. In more sensitive or policy-driven environments, diversification, liquidity, and risk management become more important. That's not a reaction to fear. It's a response to structure, because long-term financial success doesn't come from trying to guess the future perfectly. It comes from building a framework that works across different scenarios. And that's the real advantage, not certainty, but adaptability. Once you think this way, you stop asking, "Is collapse coming?" And you start asking, "How do I stay positioned regardless of what happens next?"